Hi, this is Chris Kimble with Kimble Charting Solutions. Thank you for joining me today. In this short video, I will discuss fundamental valuations, sentiment, and unique patterns. Today is November 23rd, 2013. As a student of Sir John Templeton, fundamental valuations have always been important to me. Today we're going to take a look at the Q ratio. The Q ratio was created by Nobel laureate winner James Tobin. You can find the Q ratio on an updated basis at dshort.com. The Q ratio is defined as the total price of the market divided by replacement cost of all of its components. So looking back over the past century plus, the red dotted line reflects several peaks in the Q ratio, which often come in around the reading of 1 to 108. The current reading of the Q ratio is highlighted in yellow at 1. So as you can see, the current reading is close to peaks of this ratio over the last century, except for I excluded a time window of 4 years, which was 1996 to 2000, where the Q ratio reached 163, which was obviously the highest reading in all of history. So the take from this slide is that the late 1990s was closer to an aberration in this ratio than a norm. We can't overlook that time period, but excluding the years of 1996 to 2000, the take from the Q ratio right now is that it is at lofty levels. James Bond's product or gadget developer, Q, says to James, every once in a while, the Q ratio can be very helpful to investors. On the prior slide, we just discussed the Q ratio, so I wanted to overlay the Q ratio with the Dow over the last 100 years. We discussed how oftentimes the Q ratio is at a lofty level of around 1 to 108. We can see here in the early 19 teens, the Q ratio was 108, and that corresponded with this level in the Dow, and then it struggled for several years, losing a good part of its value. Then the Q ratio dropped down to 0.3, and you'll notice that was a good time to buy the market. Then in turn, the Q ratio went back to a reading of 108, which happened to be in 1929. We all know the results of that. Then again, the Q ratio dropped to 0.3. You'll notice that was a good time then in 1932 to invest in the Dow. Then the Q ratio shot back up to 108, which was in the mid-1930s. And you'll notice that the Dow lost a good part of its value by the mid-1940s, and still by the late 1940s, the Dow was at the same price as the mid-1930s. Then, so the market was of a good valuation in the late 1940s. You'll see right in here where the Q ratio again came down to around the 0.3 level, and we had a large rally in the Dow from the late 40s to the mid 1960s, to where again then the Q ratio reached the level of almost 1, and then the Dow went sideways, as we all know, for over a decade and a half. When I first got into this business in the early 1980s, you'll see then the Q ratio reached 0.28, which was the lowest level of this century, and that's when it embarked on the huge bull market, leading to the Q ratio hitting the lofty level of 163 back here in 2000. So we can see that many peaks occurred not in the Q ratio around the 1 level, and at the same time peaks occurred in the Dow, excluding the years of 1996 to 2000. Then on the flip side, anytime the Q ratio was around the 0.3 level, it was pretty good prices or a time to enter. So the thing that gets me right now is the current reading on the Q ratio is 1. If you follow this line over, you'll notice that this is where the Dow is right now. If we connect the highs of 2000 to 2007, you'll notice it's Dow's up against resistance. And I want to then tie in a few of what I call emotive points, which is emotional highs and lows. If you take the high of 1987 as an example, and you run that and tie it into the lows of the terrorist attack low of 2001 and 2002, it also comes into the same price point. As many of the viewers have known, I've talked about Dow 16,000 as being very important to us. So the take from this slide is excluding the years of 1996 to 2000, the Q ratio is reaching very lofty levels as the Dow is hitting long-term resistance lines. This slide, we're going to switch from fundamental valuations to sentiment. This slide highlights that newsletter writers have rarely been this bullish. This window covers from the late 1990s to current. The red highlights reflect that only six times since the late 90s have 70% or more of newsletter writers been bullish on the market. You can see the first time was in the late 1990s. The S&P experienced a 20% decline. The second time, ironically, was after the 2000 top into 2001 when the market declined and newsletter writers felt like it was a bargain. And you can see there was over 70% of them bullish, and you know the results. After the terrorist attack, the market rallied back up, and then newsletter writers became bullish again, a reading of in excess of 70, and the S&P declined. In 2006, newsletter writers became, over 70% of them became bullish, and the market continued higher for well over a year. And then we had the financial crisis. And then two times since the financial crisis, in 2010 and 11, we saw that we had financial news writers over 70% bullish, and we saw some minor declines. And so this is now the seventh time since the late 1990s that 70% or more of newsletter writers have become this bullish. And so the take from this slide is this doesn't mean that a market top is in, but we do have to realize that each time this has taken place, within a window of time, declines did take place, or the market struggled to move much higher. And again, since the 2009 bottom, we've seen a couple of minor declines in the S&P when newsletter writers, 70% or more of them, were bullish. In the late 1990s, Sir John Templeton shared with me that it was his opinion the stock market, at best, would move sideways for the next 18 years. Now, why would he say that? Well, this slide covers a couple of the reasons why. The top part of this is the S&P 500, and again, the dates, if you look at the bottom of the chart, are from 1997 to current. This is the S&P 500. This section right in here covers investors' either positive or negative net worth, and this section covers the amount of money that's on margin. Part of the reason that he was concerned about the marketplace at that time in the late 1990s was the amount of money that people had borrowed in their margin accounts, which had forced their net worth into the lowest net worth readings in all of history. And we know the results that the S&P after that point in time lost 50% of its value. Now, after the 50% decline, you'll notice that net worth rose and the amount of money in margin accounts decreased significantly. So we would think maybe that investors had learned a lot and that wouldn't happen again. But you'll notice by the time 2007 rolled around, net worth had turned negative, not quite as negative as the 2000 peak, but the actual dollar amount that was on margin was hitting now record proportions. And then we know that we had the financial crisis. Well, then after the financial crisis, we'll see that net worth actually became the most positive at any time that this chart covers. And you'll notice the amount of money on margin dropped significantly. So again, no way for history to repeat itself, right? People would not borrow monies again and drive their net worth to negative levels. But we'll notice right now that margin debt is roughly to the level of the 2007 peak, and then the net worth of individuals is close to the 2000 readings. So again, this is kind of a combination chart of sentiment and valuations. The take from this chart is people have borrowed a lot of money on the stock market, and their net worth, because of the margin levels, is reaching very lofty levels. Now, does this matter? One of my favorite phrases, it doesn't matter until it matters. So the following slides will cover in greater detail of some of the things that I think matter even more, but we cannot overlook where these valuations, sentiment, margin, debt, and newsletter writers, where these readings stand at this time. What you're looking at here is a post that I did in May of 2011 that I entitled Lookalikes, Dominoes, and Slippery Slides. The bottom six-pack covers the S&P 500, IFA, Shanghai Index from China, the Russell 2000, emerging markets being EEM, and the CRB Index. And the reason I entitled this is lookalikes is you'll notice on a global basis in a variety of asset categories, we were seeing rising wedges or pennant patterns taking place with the markets up against resistance. Now, there was some other things taking place behind the scenes that we will cover in other slides, but my point of this slide was 2/3 of the time rising wedges lead to markets falling in price. And the one thing that I think is an intriguing fact is what goes up in a down market. And the answer is not inverse funds, which they do, but what goes up in a down market is correlation. And so my concern was many of the key markets around the world were looking alike. And if one market broke support, they would probably look like dominoes, have a domino effect, and that could all turn into a slippery slide and move lower. So again, the take on this slide is correlation was extremely high at that time, and there was some things going on behind the scenes then that we will cover that led me to be concerned about the marketplace. Now, not long after this, the largest decline in the S&P since the financial crisis took place, to where the S&P by October was over 15% lower than the times that I did this post. The reason that I brought up the prior slide on lookalikes, dominoes, and slippery slides is now this is an update, a six-pack of current conditions from a wide variety of markets around the world, looking at France, London, the Hang Seng Index, China, the S&P 500, and Germany. As a prior slide, we discussed lookalikes, dominoes, and slippery slides, and I highlighted this, we are the world. This is essentially a global snapshot showing that many of the key markets around the world have either formed rising wedges, as France is depicted here, Germany, and the S&P 500, or they're up against other resistance lines. But things are a little bit different now than in May of 2000. But I wanted to highlight that many of the key world's marketplaces are up against resistance at this time. In this slide, we're going to look at the Dow since 1960. Well, we know that if you tie in the highs of 2000 and the highs of 2007, that the Dow is now butting up against that resistance line. But if we also bring in and tie in the highs of 1987, and the 2002 and 3 lows, and you run it into the future, that we happen to match where the Dow again is at 16,000. And as a viewer of the blog that I imagine and through the newsletters, I've discussed since May that 16,000 could be a key price point. So you're seeing a couple of reasons why. But let me add in one more reasons why I think this intersection is even more important. So speaking of emotional highs and lows, let's take the time that President Nixon was impeached. The Dow incurred a 50% decline going into 1974. And then let's tie the 2009 financial crisis low, and then let's apply the Fibonacci to those two lows and apply it to a Fibonacci extension 261 percentage, and it also happens to meet at Dow 16,000. So this is why I've said for many months that I thought Dow 16,000 was an unusual and important price point. So it's rare, in my opinion, of doing this technical analysis for 30 years, that we could see so many emotive points, these emotional highs and lows, coming together and adding a Fibonacci sequence to it. So the take on this is an unusual circumstance of meeting Emoto points with a Fibonacci extension level tied to two of the most important lows over the last 40 years. This slide is going to discuss the importance of the advanced decline line. I want to first highlight the period of the mid-2007s. So we looked at the price of the S&P, we'll notice that it was progressing, making higher highs. But if we really looked underneath the market, we'll notice that the number of stocks advancing versus declining was creating a set of lower highs. So which one was the message that we should really listen to? Well, in the end, who was the accurate message was the advanced decline line, as these lower highs led to a significant decline in the S&P 500. Well, what about this time period? So we're going to look at the lows of the financial crisis. Well, you notice that the S&P was making lower lows here, but what was really happening underneath the market? As the S&P was making lower lows, fewer stocks were making new lows. So in other words, the advanced decline line was making a set of higher lows, which resulted in a strong rally in the S&P coming out of there and a rally in the advanced decline line. Well, what about this time period? Well, roughly, a year and a half after the financial crisis, the S&P essentially was making a series of lower lows right in here concerning the marketplace. But if you'll notice above, if we looked at the advanced decline line, there was actually a lot of strength taking place as fewer and fewer stocks were declining and actually more of them were advancing, creating a series of higher lows in the advanced decline line, which was a bullish message. And we all know, looking in the rearview mirror, the market moved a ton higher. So even though we can have sentiment readings that are lofty and valuation levels that are lofty, as I mentioned earlier, it doesn't matter till it matters. This is one of the key pieces that I feel in the short term that really matters to us is, are the troops following the generals? In other words, how many stocks are advancing compared with declining? And we're going to look at the current reading of this, but I wanted to look back at key highs and lows and even a sideways trading pattern over the last few years and the importance of the advanced decline line. In this slide, we're going to take a look at, in the upper left, the S&P 500, the lower left, my shoebox indicator, and in the right, take a look at PIMCO's high yield fund. High yields, I believe, give us very good message for the future direction of stock markets, but I just want to let you know that I much prefer to view high yield funds over the ETFs, the two most popular junk bond ETFs being JNK and HYG. I believe we get better messages because these funds can't be pushed around by volume like the ETFs can. Okay, let's look at this little window, which is back in 2006 and 7. You see that the S&P was making higher highs, but here was another time frame where, similar to the advanced decline line, the shoebox indicator was reflecting essentially lower highs. And the shoebox indicator is created by credit pricing, not government bonds or corporate bonds, but some unique credit tools that I believe, like the junk bonds in combination, can really give us some quality messages of significant highs and also important times to be investing into the market. So looking back in 2007, again, we can see if you looked at the message of price alone on the S&P, we saw higher highs, but the shoebox indicator was reflecting that the credit people in the background, they were really starting to get concerned about things. You saw this lower highs, and we all know what happened during the financial crisis. Well, another thing that interested me at that time frame is, if you'll look over here at the PIMCO fund, that despite the market continuing higher in the window of 2005 and 6, the high yield marketplace, the pricing of these bonds struggled to move any higher. So there was a little bit of a concerning message on its own, is that they weren't quite following up with the marketplace. So the take that I want to look at right now in the from a shoebox indicator perspective is that the shoebox has been fairly weak since May, but you'll notice this green line that any time that the shoebox has gotten down to this support line, the S&P has been at a good point to actually be a buyer of it. So once the shoebox hit this support line, which was back in September, we've seen the S&P actually, move higher. Now the take from the shoebox indicator right now is support until broken. So the credit guys haven't increased their concerns. They've driven, the shoebox indicator down to support. But as I've shared for several weeks now in the weekly newsletters, is that if the credit guys would push the shoebox indicator below support here, that would be the most negative message coming from these credit players since 2010. So as I've mentioned, they don't matter until they matter. The sentiment is fairly lofty. We've covered that, earlier. The valuations and the Q ratio is fairly lofty. But what does matter, again, is looking at the advanced decline lines. What are we seeing there when we lift up underneath? How's the shoebox indicator doing? And how's the high yields? Now, so far over the last few years, each time that the advanced decline line has moved up, the shoebox has been on support, and the high yields are okay, despite lofty sentiment readings and valuations. Each time that the AD, shoebox, and PIMCO funds, or any of the high yields, have been moving higher, when the market declined, it was actually a time to be a buyer, not looking to be aggressive short. So it's okay, to want to harvest some stuff, some of your assets up against resistance lines. There's nothing wrong with that. But I've hesitated to move into any aggressive shorts for a long period of time because of these indicators that you're seeing on the screen between the advanced decline, shoebox, and high yields. We need to see those break down because so far it has not paid to short once over the last few years when these indicators were actually in a positive circumstance or moving higher. In summary, today I was to speak about valuations, sentiment, and patterns. From a valuation perspective, the Q ratio reflects it's at lofty levels. From a sentiment perspective, only 6 times in the last 17 years has this many newsletter writers been this bullish. And of the 6 prior times, the market struggled to move higher. Margin debt is at historical levels, reflecting confidence in the marketplace. And from a technical perspective, the Dow is facing Fibonacci extension and long-term resistance lines. When it comes to the marketplace, bottoms are events, oftentimes emotional events, and tops are a process that can take a lot longer than many think. So for today, it's a go sign. Why a go sign? The shoebox is on support, high yields are moving higher, and the advanced decline line is making higher lows. Until these things change, which they can quickly, the positive momentum of the marketplace should push it higher. Should the shoebox break down, high yields act weak, or advanced declines break down? If they do, I will notify you as a member immediately. Thank you for your time today, and I appreciate your business.